In today's interconnected global economy, the fight against money laundering has become increasingly critical. Financial institutions and regulatory bodies work tirelessly to detect and prevent the movement of illicit funds through legitimate channels. This presentation explores the complex world of anti-money laundering, AML, examining the mechanisms used to conceal criminal proceeds, the regulatory frameworks designed to combat these activities, and the evolving technologies shaping the future of financial crime prevention. Money laundering is the process of concealing the origins of money obtained through criminal activities. These funds are dirty money that criminals attempt to clean through various financial transactions. Key crimes generating illicit funds include tax evasion, corruption, fraud, human trafficking, and terrorist financing. The United Nations Office on Drugs and Crime estimates that approximately $3.1 trillion in illicit funds flowed through the global financial system in 2023, representing 2 to 5% of global GDP. The classic money laundering process involves three key stages: placement, layering, and integration. Placement is the initial entry of illicit funds into the financial system, often through cash deposits or purchasing assets. Layering involves creating complex transactions to obscure the money trail, using multiple transfers between accounts or shell companies. Integration returns the now clean money to the economy in seemingly legitimate forms, such as investments or business ventures. Money laundering has far-reaching consequences beyond the financial realm. It enables criminal activities like terrorism and organized crime, undermines economic stability by distorting markets, and erodes trust in financial and government systems. The unchecked flow of illicit funds can create unfair competition, trigger financial crises, and incentivize further criminal activity. The scale of global money laundering is staggering, with illicit funds flowing through virtually every financial market worldwide. These flows are not distributed evenly, with certain regions serving as key nodes in the global laundering network. Developing economies with weaker regulatory frameworks often suffer disproportionately from the effects of money laundering, affecting nearly every nation. Fighting money laundering is essential for maintaining the integrity of the global financial system. By cutting off the financial lifeblood of criminal enterprises, AML efforts reduce the profitability of illegal activities and deter future crimes. Additionally, countries with robust AML frameworks enjoy greater international trust and access to the global financial network. Anti-money laundering, AML, comprises laws and regulations designed to prevent criminals from disguising illegally obtained funds as legitimate income. These regulations establish requirements for financial institutions and other entities to identify unusual patterns that may indicate money laundering. Practical implementation includes policies, procedures, and technologies that support suspicious financial activities. AML focuses on preventing criminals from processing illicit funds through legitimate financial channels, targeting proceeds of crime entering the system. In contrast, countering financing of terrorism, CFT, concentrates on preventing funds used for terrorism, regardless of their source. CFT often involves smaller, harder-to-detect amounts, primarily concerned with the destination of funds. The Financial Action Task Force, FATF, was established by the G7 nations in 1989 to address money laundering and later expanded to include other crimes and terrorism financing. FATF developed 40 recommendations that form the foundation of most national AML legislation worldwide. The introduction of the Grey List in 2000 created powerful incentives for countries to strengthen their AML frameworks. The International AML Framework functions as a complex ecosystem of standards, laws, and cooperative arrangements. FATF recommendations establish global AML best practices, while countries adopt laws based on the FATF framework. Mutual evaluations assess country compliance, and cross-border collaboration enhances cases and intelligence sharing, addressing the global nature of money laundering. Key AML legislation varies by region, with the United States, United Kingdom, European Union, and Basel Committee each having distinct frameworks. The Bank Secrecy Act in the US laid the foundation for AML, while the UK's Proceeds of Crime Act targets money laundering. The EU's AML directives and Basel AML principles provide guidance for banks, complementing FATF recommendations. AML compliance is required across a wide range of institutions, including banks, insurance companies, and professional services like lawyers and accountants. Obligations vary by country, with each jurisdiction designating specific sectors as obliged entities under local AML laws. Other regulated entities include real estate agents, casinos, and cryptocurrency exchanges. An effective AML program integrates risk assessment, customer due diligence, transaction monitoring, reporting, and record-keeping into a comprehensive system. These elements are supported by robust governance, clear policies, ongoing training, and regular independent testing. The program must be risk-based, allocating resources to higher risk areas. Know Your Customer, KYC, is a critical component of AML, involving customer identification, screening, and ongoing due diligence. Customer identification establishes a true identity, while screening checks against sanction lists and politically exposed persons. Ongoing due diligence reassesses the customer's risk profile based on transaction patterns and changes in circumstances. Customer due diligence, CDD, involves varying levels of scrutiny based on risk scenarios. Simplified due diligence is used for lower risk situations, while standard due diligence applies to average risk clients. Enhanced due diligence is reserved for high-risk relationships, requiring intensive verification and monitoring. Politically exposed persons, PEPs, are individuals who hold or have held prominent public functions, posing heightened money laundering risks due to their potential access to government funds. Financial institutions must apply enhanced due diligence to PEPs, including obtaining senior management approval for relationships and conducting closer monitoring of transactions. Transaction monitoring involves collecting data on access, products, and channels, using automated analysis to detect anomalies. Alert generation occurs when suspicious patterns are detected, prompting human investigation to determine if there's genuine suspicion. This process helps establish normal patterns and identify high-risk transactions. Suspicious activity reports, SARs, are filed when unusual transactions or patterns trigger enhanced scrutiny. Compliance teams review the activity to determine if a report is warranted, considering the customer's risk profile and transaction history. If suspicion remains, a detailed SAR is submitted to the National Financial Intelligence Unit, maintaining confidentiality throughout the process. The risk-based approach allows organizations to allocate compliance resources effectively by focusing more attention on higher risk areas. This method results in more efficient resource allocation while maintaining effective risk management, targeting high-risk clients, products, and geographies. AML supervision involves regulatory oversight and examination methods to assess compliance. Financial regulators monitor institutions under their jurisdiction, reviewing policies, procedures, and governance structures. Supervisors employ various techniques, including on-site inspections and remote monitoring, to gain a comprehensive view of an institution's AML framework. In today's digital age, record-keeping and data retention are crucial for financial institutions. Most jurisdictions require financial institutions to maintain records for a minimum of 5 years after a transaction is completed. This is to ensure compliance and protect against high-risk transactions. Additionally, institutions must retain all customer identification data and account files to prevent criminal activity. Records must be stored securely to prevent unauthorized access, ensuring they are readily accessible for review purposes. Financial intelligence units, or FIUs, play a pivotal role in combating financial crimes. They serve as central repositories for suspicious activity reports, analyzing and enhancing submitted reports to identify patterns and connections. FIUs share actionable intelligence with law enforcement and other authorities, facilitating investigations and prosecutions. International cooperation through organizations like the Egmont Group strengthens cross-border financial crime investigations. Penalties for AML failures can be severe, with global fines reaching $12.5 billion and single fines as high as $2.9 billion. Regulatory authorities have increased both the frequency and severity of penalties for AML compliance failures. Beyond financial penalties, institutions face potential criminal prosecution, restrictions on business operations, and reputational damage that can affect share prices and customer relations. The HSBC AML breaches case study highlights significant compliance failures. Between 2006 and 2009, HSBC's Mexican operations processed billions in drug cartel funds. Inadequate staffing and systems allowed these transactions to bypass high-risk jurisdictional exposure. In 2012, HSBC agreed to pay $1.92 billion in fines and penalties, leading to a major overhaul of their AML systems and staff, exiting multiple high-risk markets. The Danske Bank scandal is a prominent example of money laundering in Europe. Between 2007 and 2015, approximately $200 billion in suspicious transactions flowed through its Estonian branch. Key failures included inadequate customer due diligence, deliberate circumvention of banking controls, and ignoring internal whistleblower reports. This scandal highlights the importance of robust AML controls and the risks of non-resident account operations. AML failures have consequences that extend beyond fines. Leadership changes often occur, as seen in the Danske Bank case, where senior executives and board members were replaced. Banks may exit markets or business lines after major AML incidents, as HSBC did post-2012. Reputational damage can severely impact institutional reputation, affecting share prices and customer trust, highlighting the importance of effective AML enforcement. Beneficial ownership is a critical concept in AML controls, referring to individuals who ultimately own or control a legal entity. Most jurisdictions define beneficial owners as individuals with ownership exceeding a specific threshold, typically 25%. Public registries have been established to enhance transparency, with the EU's fifth AML directive requiring all member states to have publicly accessible registries. Complex company structures pose significant AML risks. Money launderers often create elaborate networks of shell companies and trusts across multiple jurisdictions, complicating transparency. Regulatory challenges require cooperation across jurisdictions, with differing legal standards complicating enforcement. Enhanced transparency measures, such as beneficial ownership registries, aim to reduce the abuse of corporate vehicles for money laundering. Cryptocurrencies introduce unique AML risks due to pseudonymous transactions and decentralized operations. Regulators have extended AML requirements to virtual asset service providers, ensuring compliance with KYC procedures and monitoring. Blockchain analysis tools have emerged to analyze transactions, offering enhanced traceability compared to traditional cash transactions, aiding in AML efforts. The FATF has provided recommendations for crypto assets, defining virtual asset service providers and ensuring they comply with AML CFT controls. The travel rule requires VASPs to obtain and verify transaction information during transfers. Global implementation varies, with countries adopting FATF standards to regulate VASP risk, ensuring compliance with international financial systems. Trade-based money laundering is one of the most challenging forms of financial crime. By manipulating legitimate transactions, criminals can move value across borders without triggering traditional AML controls. Effective countermeasures require close cooperation between customs authorities, tax agencies, and financial institutions across multiple jurisdictions. The real estate sector is particularly vulnerable to money laundering due to several inherent characteristics. High-value transactions, price volatility, and fragmented regulatory oversight make it susceptible. Authorities worldwide are implementing enhanced measures, including extending AML obligations and geographic targeting orders to strengthen controls. The art and luxury goods market presents unique money laundering risks through subjective valuations and private transactions. Regulatory evolution, such as the EU's fifth AML directive, aims to address these vulnerabilities. Implementing effective AML controls requires balancing traditional practices with due diligence challenges. Casinos handle large volumes of cash, making them attractive for money laundering. Compliance requirements include monitoring high-value transactions and reporting suspicious activities. Technological controls, like advanced player tracking systems, help identify potential money laundering while supporting legitimate customer relationships. Professional services, including legal professionals, accountants, and company formation agents, face AML challenges due to complex corporate structures and transactions. Trust service providers must navigate asset protection arrangements and fiduciary ownership structures, requiring robust AML measures to prevent illicit activities. Technology is transforming AML efforts with machine learning applications, natural language processing, biometric authentication, and distributed ledger solutions. These innovations help detect anomalies, verify identities, and ensure secure sharing of information, enhancing the effectiveness of AML programs. Big data analytics in AML goes beyond simple rule-based monitoring. It helps identify relationships between seemingly unconnected accounts and establish normal patterns for customer segments. Predictive models and unsupervised learning discover new typologies of money laundering, enhancing comprehensive monitoring capabilities. AML deficiencies often stem from customer due diligence failures, technological weaknesses, training gaps, and governance shortcomings. Addressing these issues requires robust verification processes, effective training programs, and strong governance frameworks to ensure compliance and prevent money laundering. Emerging threats like decentralized finance, identity exploitation, mobile payment proliferation, and pandemic-related schemes pose new challenges for AML efforts. These developments require innovative compliance measures to address vulnerabilities and ensure effective monitoring in a rapidly changing financial landscape. Global AML coordinating bodies like the Financial Action Task Force, Egmont Group, and Interpol play crucial roles in developing policies, facilitating information exchange, and maintaining databases of suspected criminals. Their efforts are essential for international cooperation in combating money laundering. The UK maintains a comprehensive AML regime with multiple supervisory authorities responsible for different sectors. Treasury sets policy direction, while the Financial Conduct Authority supervises financial firms. Collaboration among these entities ensures effective AML compliance across the UK. The Proceeds of Crime Act establishes primary offences related to money laundering, including concealing criminal property and tipping off. It also provides asset recovery powers and imposes obligations on individuals to disclose knowledge or suspicion of money laundering, ensuring accountability and enforcement. The UK's money laundering regulations have evolved through amendments to address emerging threats. From implementing the EU's third directive to strengthening beneficial ownership requirements, these regulations ensure comprehensive compliance and adapt to the changing financial landscape. Established in 2015, the Joint Money Laundering Intelligence Task Force represents a pioneering public-private partnership. It enables rapid information sharing and collaboration among law enforcement, regulators, and financial institutions, overcoming barriers between sectors to combat money laundering effectively. Regular independent testing of AML programs is crucial for ensuring compliance and effectiveness. These audits review the scope, objectives, and methodology, verifying remediation of identified weaknesses and documenting findings to enhance AML efforts across jurisdictions. Effective AML training must be tailored to specific roles, emphasizing the importance of compliance through clear messaging and resource allocation. A strong reporting culture encourages staff to raise concerns, fostering an environment where compliance is prioritized over commercial pressures. Recognizing red flags in money laundering involves observing client behavior, transaction patterns, and structural indicators. Reluctance to provide standard information, frequent cash movements, and complex ownership structures are key signs that require further investigation to prevent illicit activities. Monitoring cross-border payments involves analyzing SWIFT MT formats and correspondent banking relationships. These processes help identify suspicious activities and ensure compliance with AML standards, addressing risks associated with high volumes and varying transaction parties across jurisdictions. Sanction screening is essential for AML efforts, requiring institutions to match clients against multiple lists and jurisdictions. Effective enforcement actions, including penalties and restrictions, ensure compliance with international sanctions, targeting countries linked to economic restrictions. A comprehensive financial crime risk assessment evaluates inherent risks across various sectors and jurisdictions. This process helps institutions allocate resources efficiently and adjust strategies, ensuring enhanced AML measures and effective risk management in a dynamic business environment. Non-bank payment firms, including service providers and electronic money institutions, must adhere to AML regulations across most jurisdictions. These firms often face more stringent compliance requirements than traditional banks, necessitating innovative approaches to digital identity verification and API-based monitoring to ensure secure and efficient operations. RegTech is revolutionizing AML with digital identity solutions, intelligent monitoring, and collaborative utilities. These innovations enhance security, improve detection accuracy, and streamline processes, allowing firms to adapt to new threats and regulatory changes with greater efficiency. An effective AML program integrates governance, risk assessment, policies, systems, and training into a cohesive strategy. This approach ensures compliance while adapting to evolving risks, balancing enforcement with operational efficiency. AML compliance faces challenges in balancing privacy with disclosure and keeping pace with rapid technological evolution. Financial institutions must navigate complex regulations and adopt advanced monitoring tools to maintain effective controls while addressing customer privacy concerns. AML compliance costs are soaring, with global financial industry spending reaching $213.9 billion annually. This increase is driven by regulatory expectations and the need for advanced technology and training to combat financial crimes effectively. Strong AML controls offer risk mitigation, market integrity, business advantages, and operational insights. These benefits help institutions protect themselves from financial and reputational damage while enhancing customer trust and competitive differentiation. AML controls are integral to ESG initiatives, contributing to social responsibility by preventing financial crimes and supporting sustainable development. Effective AML practices can impact ESG ratings and stakeholder expectations, influencing investment decisions and corporate governance. The future of AML lies in AI-driven integration, unified digital identity, and global regulatory alignment. These advancements will transform compliance from reactive to proactive, enabling institutions to identify and address risks before they escalate. AML is a collective responsibility requiring coordinated efforts across sectors. Stakeholders must focus on risk-based resource allocation, embrace technology without replacing human judgment, and continuously adapt to evolving threats to maintain effective AML strategies.